All right, why don't we kickstart it? That's a few minutes into it now, and again, as always, there will be recordings made available. We will usually try and send these out a few days after, just as we make some tweaks and some subtle, I suppose, changes and amendments if we need to, as well as some comments as well. So again, thanks for joining us today on today's webinar. I suppose, as we all know, today is touching base on the recent budget, which was announced earlier this week, and then obviously laying it with an Australian expat sort of theme as well. Moving through it into the next slides. Bit of a legal disclaimer as always, so just going to read out some of the main points. Again, presentation is made on the basis that it contains only general as opposed to personal advice. This means that it has been prepared for multiple distribution without considerations of your investment objectives, financial situation and needs. So again, this webinar is not construed as advice. It's general in nature and I suppose should only be consumed for entertainment purposes only, much like our podcast. If you require assistance with this or any other sort of personal recommendations in the future, you should seek advice from either a tax accountant, tax lawyer, or a financial advisor. As we go along the webinar, guys, feel free to drop in your questions or concerns. I'll try and get to them at the end. As I said earlier, that's when a lot of the good material sort of comes out. Obviously, expats, they all have similar issues around the world, no matter where you are. Because we're doing this at 11 a.m. today, it's usually covering, again, the APAC region, Asia, the Americas. Obviously, within the US, it'll be quite late for some individuals, so I appreciate that. But we'll try and get through it. Who is Atlas Wealth Management? Well, Atlas Wealth, we're the leading provider of Australian expat tax financial advice. We've won multiple domestic and international awards for the services that we provide. We are classified as a tax financial advisor with the Tax Practitioners Board in Australia, so that's a very good designation to hold, and most advisors need to move towards that. With clients in over 30 countries, our specialty is in providing Australian expat tax financial advice, and all of our financial advisors are degree qualified with numerous postgraduate certifications. Atlas Wealth holds an AFSL, which is an Australian Financial Services Licence, the number there, 471653, as well as our other branch, Atlas Wealth DIFC. That just stands for Dubai International Financial Centre, which is where Brett is based, and he's regulated as well by the Dubai Financial Services Authority, which is the ASIC equivalent here in Australia. Just going to double check one thing just to make sure that's coming across fine. There we go. Sorry, guys. Moving through it. So who are Brett and James? Brett Evans there on the left, the one for the head for radio. He is the founding and managing director for the EMEA region, Europe, Middle East and the Africas region. I myself, James Ridley, I'm the managing director for the APAC region, which is, again, the Asia Pacific and Americas region. We both specialise in those regions because the tax, I suppose, treatments of certain offshore assets and assets in Australia is very different. Moving through to today's agenda. So I suppose going through the main points, budget at a glance, tax, migration, superannuation, update on equities, update on the property market at the moment, update on the currency, and then again, opening up for Q&A. At the end there. Again, as I said, that's when a lot of the good talking points come out, so please do drop in your comments or your questions if you have any at the moment. Okay, let's kick started. So I suppose budget at a glance, I mean, for Australian expats, we're glad to see that it was a relatively soft budget, to be honest. We scoured through the 700 odd pages and found some items which are relevant overall, but we're relieved to see that it wasn't anything like, I suppose, the 2017 budget when they announced that they wanted to abolish that main residence exemption, which they have now. They did that in December 2019, but it's good to see no policies like that being fed into us. I suppose it was also somewhat unexpected budget, tax reform, getting more into consumers and businesses' pockets to keep spending, keep the economy going. But again, remember, we do have another budget coming out in May, so only months, I guess you could say, away. So it's going to be interesting to see what that one brings as well. Looking at the numbers. So the budget deficit is 213 billion as opposed to the surplus of 6 billion, which was forecasted 10 months ago, so obviously just before COVID-19 or at the start of the year. A budget deficit in 2020 to 2021 of 11% of GDP, and there's a graph on the next slide which I'll show you just as to reflect the magnitude of the deficit. Again, they're an outcome that we haven't seen in Australia since the end of World War II. So net debt to GDP, so deficit as a percentage of GDP or gross domestic product. So as we can see here in 1943, that was the peak of the debt as a percentage of GDP. We obviously haven't seen anything like that since, and we note that, I suppose, with this budget, this deficit, 2020 getting right up there again. Haven't seen anything like it since then. Something comparative, obviously, it was pre that World War II era. And I suppose the budget, it's presenting that roadmap of how do we get back as they're forecasting here with these figures. I suppose from clients themselves, we've heard some pretty disastrous stories from consults, general clients about that's been brought about from COVID-19, as well as some silver linings, which that's going to continue on, unfortunately, but we are obviously seeing a slow recovery predicted here. So how do we spend $81.1 billion out of this budget? Well, at the moment, most of these are relating to small businesses, I suppose business concessions, as well as government spending and I suppose tax cuts as well. So at the moment, 2020 to 2024, temporary deduction for the full cost of eligible assets for businesses with aggregated turnover of less than $5 billion. So that's mainly companies outside of the banks, the healthcares and the resources. I understand a lot of these aren't specific to expats, but just want to go through it as a summary before we touch the other agenda items. Bringing forward Stage 2 personal income tax cuts to apply retrospectively from 1st of July 2020, so already in effect right now technically, previously meant to apply in 2022 financial year. JobKeeper payment extension, so they've extended that in the meantime. It's going to be interesting to see how far that goes, just as they're not predicting that we'll have a vaccine or even our borders will be open by the end of next year. So it'd be interesting to see how that plays out. New transport infrastructure investment, $7.5 billion. Temporary tax loss carryback for eligible companies with turnover less than $5 billion, generating refundable tax offsets against previously taxed profits. That's a good one. JobMaker hiring credit paid to eligible employers for taking on eligible employees aged 35 or under. That's a good one as well for incentivising people to bring back their workforce. Additional $250 economic support payments for eligible welfare recipients, and then again enhancements to research and development tax incentives. The R&D tax incentives, they're usually always in there, to be honest, which is good to see that they haven't really removed those, but again very small out of the whole, I suppose, budget at the moment for the $81.1 billion. This next slide, just a brief summary. What do these stand for? EFO. So that stands for Economic and Fiscal Outlook. It paints a good picture. When we put together this table, I actually did it backwards. I should have put the 2019-20 budget at the top there, but that's okay. I'll explain the way this operates. So when we first had the budget last year, this was the roadmap. We're going from a net debt position of $361 billion, and it was winding down, which is great to see, surplus. So it was winding down slowly leading into 2024. At the end of the 2020 year, the outlook, similar sort of theme, winding down, but obviously the debt was still up. But again, it was winding down because of the predicted surpluses that we were going to have. As of July 2020, the economic fiscal outlook now at $488.2 billion. And then increasing, and no sort of further guidance was sort of looked at past that towards 2021. And now with the 2021 budget released this week, right now $491.2 billion debt or net debt, increasing each year as they keep the economy going and keep a lot of those initiatives going, and towards 2024 predicting that it's going to get up there to almost $1 trillion. So very concerning, the size of that, but again, that's why we have these budgets. Again, there's going to be another budget come May next year, so it'll be interesting to see what these revised, or what their revised forecasts look like comparing to these ones that they've released this week. Moving through, to the next step. So our view, I suppose, as a whole, on the budget right now. So the government has gone all in with the budget, betting on the private sector to pony up and drive the post-coronavirus economic recovery for the nation. Treasurer Frydenberg has put the challenge out to the private sector to pull the flailing economy up by its bootstraps. He's done this through a broad suite of policy initiatives, including brought forward personal income tax cuts, full expensing for depreciable business investments, wage subsidies to encourage the employment of new staff, and reforming insolvency arrangements to aid businesses to continue to trade. So trying to engage, I suppose, Australian business to spend money, buying assets, being able to utilise, tax breaks, depreciating assets, being able to be written off immediately, obviously reducing companies' tax payables, so they're getting the benefit of that asset immediately, as well as incentives for hiring and spending as well with the tax cuts. So moving into tax, so what are they actually doing with tax at the moment? Well, the main item was bringing forward the personal income tax cuts. So the government will bring forward the second stage of its personal income tax plan by 2 years to 1 July 2020. As a result, the top threshold of the 19% personal income tax bracket will increase from $37,000 to $45,000. And on the next page, I'll show you what's taking place with the individual tax brackets. The top threshold of 32.5% personal income tax bracket will increase from $90,000 to $120,000, as well as stage 3 of the personal income tax plan at the moment remains unchanged and will commence in 24 to 25, and that's with the intention of essentially creating, I guess, what you'd call a mega tax bracket based on the income level held within there. Just want to make sure, again, everyone can hear me and see me. I've just got a question. Someone's saying they can't hear me at all. Just a quick raise of hand, just so I can continue on. Thanks, Val. Thanks, Vivian. Okay, that's fine, Val. I'll keep going. That must be user issue on the other side. Tax rates. So this is their plan at the moment, bringing these forward as effect in the financial year right now. So if we look at the old thresholds that we're on, 0 to 18,200 tax-free threshold, anything over 18,200 to 37,000, 19%, 37 to 90, 32.5, 90 to 180, 37, and so on. So right now, this is what they've brought forward. So we can see still the same tax-free threshold, 18,200. Anything over to 18,200 to 45,000, that's now 19%. So essentially abolishing or just increasing and making that a higher tax bracket. The next bracket, 45,000 to 120. Again, we can see that, sorry ladies and gentlemen, I've just seen, I'm reading off here, not here. So we can see that the new thresholds, 18,200 to 45,000 at 19%, 45,000 to 120,000 to 30%, and so on and so forth. This was the mega tax bracket that I was talking about just before, where by 2024 to 2025, they're introducing a mega bracket of 45,000 to 200,000 with a maximum tax rate of 30%. I would say that that would bring Australia back in line with a lot of other countries when it comes to their sort of federal tax rates or main tax rates. We are a country which is taxed I suppose we tax our individuals, our residents, very highly compared to others. I think we're one of the top 3 in the world. So at the moment, it's good to see that the plan is to take that back and see what the long-term effects will have on spending as well. This next slide, it just highlights some of the positives from the budget. I mean, again, it's not something that would be really highlighted on budget night or I suppose from a lot of providers and accounts, but it's mainly around the tax treaty network which benefits expats. So right now, the government intends to modernise and expand its tax treaty network to eliminate double taxation, settle taxing rights between Australia and other countries, and attract foreign investment and skilled workers. The specific details of this modernisation and expansion are yet to be detailed, but I suppose to give you a bit of an example, by improving the double taxation agreements, it can have impacts where withholding tax amounts between a country which doesn't have a DTA will be a lot less. And that's something that we'll reflect on the next stage. But further updates to come on that one. It would be also really great if they went back and actually improved a lot of the old DTAs which were established in the 80s, 90s. A good example of that one would probably be the US. Everyone is always confused. It's a big grey area around superannuation, foreign pensions, those sort of things, on how they're treated, because when the DTA was created, superannuation wasn't really a legislated item. However, the UK pension scheme system, it is legislated within DTA between the US and the UK, which is good for the UK, but obviously we have a similar system, so we need to obviously be on par with that as well. But that's just an example of obviously improving the tax treaty network of what we hope to see coming about over the next few years. Exchange of information jurisdictions. Again, this is a bit of good news for certain clients in certain regions. I suppose when we talk about asset classes, when we're a non-resident, we have what's called taxable Australian real property, TARP, or non-taxable Australian real property, non-TARP. So a TARP asset, that's an asset which is physical in nature, bricks and mortar, so a former main residence, an investment property, a farm, maybe a mining lease, taking it a step further. So commonly these assets, they're taxed at our non-resident marginal tax rates on the income and those sort of capital gains that we make on them. So as a refresher, that income tax rates, they're not changing at all as part of the budget. Still 0 to 90,000, 32.5% on those income sources and capital gain sources. When we look at non-TARP assets, non-taxable Australian property, these assets are things like your direct shares, your exchange-traded funds, your LICs, sometimes your managed funds as well. They don't accrue any capital gains tax with the ATO when we head overseas if we're purchasing them back in Australia whilst we've been abroad. I won't go into that too much, but what we're seeing come about from this exchange of information jurisdictions is that it is improving some of the DTAs, and therefore on assets which are deemed to be non-TARP, shares, those sort of things, because now there are existing agreements between these regions, the withholding tax rate doesn't need to be 30%. It only commonly now needs to be 15%. So it means that the expat is paying less withholding tax on those that is income streams from things like your shares and those sort of things. So that's a good takeaway for expats. That's improving, that's getting better. I'll just touch on these points now. The jurisdictions that have information agreements with Australia have been updated to include Dominican Republic, Ecuador, El Salvador, Hong Kong, Jamaica, Kuwait, Morocco, North Macedonia and Serbia, and remove Kenya from the existing 122 jurisdictions on the list. Residents of listed jurisdictions are eligible to access the concessional managed investment trust withholding tax rate of 15% on certain distributions instead of the general withholding rate of 30%. The updated list will be effective from 1 July 2021. Moving into the managed investment trust. So again, they announced this the start date back in 2019 budget, a measure called the tax integrity, removing capital gains discount at the trust level for managed investment trusts and attribution MITs as well. This has been revised from 1 July 2020 to the income year commencing on or after 3 months after the date of royal assent of the relevant legislation. I'll go into this on the next slide, but this is actually good news for expats because it means expats can still get access to the 50% CGT discount concession through managed investment trusts income distributions. So originally it was meant to be in effect right now, but they've pushed it out again. There's no real clear idea or guidance on when it will be legislated or published, but as soon as it is 3 months after, that's when it is in effect. But this is good news for expats because it means they can still access some of these concessions which ordinarily we wouldn't have access to, because as the high level summary, the capital gains tax discount, so the 50% concession on capital gains made in Australia on investments, was actually removed back in May 2012. So we can, funnily enough, actually get access to that concession through managed investment trust schemes, through the income distributions that they pay us. But again, they're looking at removing that for our non-resident beneficiaries. But I'll flesh that out on this next slide. So managed investment trusts, this change will only affect non-resident members of the MIT or AMIT. The capital gains will continue to be discountable in the hands of any Australian resident beneficiaries, but again, looking to change them for non-residents. The proposal prevents non-residents beneficiaries who are not entitled to the capital gains discount in their own right from benefiting from this discount at the trust level. So again, if an Australian trust makes an investment into Australian assets, as it is a tax resident or a tax vehicle held within Australia, it will get the benefit of the local rules, such as the 50% CGT discount on the sale of capital. Unit holders will receive the benefit even though some of the beneficiaries are non-residents. So that's, again, the concession that we're still entitled to through these schemes. I mean, right now, again, government hasn't really announced when it's going to look at putting it through, but the fact that it hasn't been put through as of 1st of July 2020 and it's going to just probably get pushed aside in the meantime, that is good news because we can technically still access the concession in the meantime, but who knows when it will be legislated. Again, I've pretty much just discussed this, but I'll just make sure that that last point is talked about one more time. So it is proposed again that MITs and AMITs will no longer be eligible to apply the 50% capital gain discount at its own trust level. So right now, if you're invested in, say, a managed fund or a managed investment trust scheme, when you get your annual tax statement, it'll say all the different components as part of the distributions, you know, capital, return of capital, income, foreign sourced income, and it'll give you, I suppose, the areas in which they should be entered into your tax return, Part 13U, Part 20, interest deductions, those sort of things. So as with this update, it means that if the managed fund or investment scheme has us down as a non-resident, it means that it will reflect that differently. You know, you won't get the benefit of the discounted capital gain distribution anymore. Those are the main changes that we'll see, or you will see at the coalface. But again, not legislated, and they've put it back in the meantime, which is good. Point 3, migration. So what are we seeing going on with regards to migration? And this was in the budget. So at the moment, this is actually great news for a lot of folks, a lot of expats that are either looking to return to Australia, who have a partner or a spouse from another nationality, and they've been struggling to get that permanent residency visa. So it is a positive if you are returning back to Australia. So family visas, a one-off allocation increase from the current 43,732 places to 77,300 places. I suppose the lion's share of these places will be allocated to partner visas, so good news for returning expats. Implementation of family sponsorship provisions for partner visas, including mandatory character checks, the sharing of personal information with visa applicant, and enforceable sponsorship obligations for spouse sponsors. Or nothing's changed yet, that's all quite normal. The introduction of English language testing for partner visas for both sponsor and visa applicant with a view to promoting social cohesion. That's quite common as well. The measure alone is estimated to generate 4.9 million over the next 4 years. So not a large amount when you look at the budget overall, but still something, but just an important measure for expats if they are returning with a partner from a different nationality that has never been a resident. You know, there's an opportunity there that they'll be able to get a PR visa. Superannuation. So again, not too much on super, but they've introduced some best interest duties as well as a useful tool for employers. I suppose super best interest, so the government will clarify that from 1 July 2021, the best interest test applies to members' financial interests. So I guess also factoring in as licensed professional financial advisors, you know, they have a best interest duty when they are making recommendations for their clients. So they're taking this to the superannuation level now and applying it to trustees. So it is a good sign that on trustees, I suppose, spending their money for their members. So trustees will also be required to establish that there were or was a reasonable basis to support their actions being consistent with members' best financial interests. I think a good example of what might not be in the best interests of members' funds, or I suppose the revenue that they generate, is, you know, sponsoring the Australian Open. You know, I think Host Plus or Hester or something like that, they did that a few years ago, or sponsoring NRL matches, those sort of things. I mean, how can a trustee of a super fund show that that's in the best interests, that's in their own interest, trying to generate more members and marketing and those sort of things? So those are things which are being regulated now, being brought under the microscope for the use of the members' revenue from the funds. Super underperformance. So this is a great one as well. Another important element, so underperformance checks. So there'll be a new annual investment performance assessment for my super products and trustee-directed products, those products and options where the trustee has control over the investment strategy, which covers more than one asset class. So that might be your my super, your balanced option, your high growth option, whatever option you're in, but mainly where it covers multiple asset classes. The first assessment is to be completed by APRA in September 2021, so about a year away or just under. The assessments will be based on APRA's heat map methodology. I suppose right now, it's quite common that when expats leave, they're super behind. Don't really think about it. It's in the back of your mind. You don't look at contributing or looking at how it's invested or whether it's invested correctly or even just how that super fund, whether it's an old legacy product, is performing as well. So by bringing this in, it's really going to name and shame those who aren't doing well. A fund which continues or a fund which underperforms for 1 year must notify members. A fund which underperforms for 2 consecutive years will be prohibited from receiving new members until it ceases to be underperforming. So that's a big measure for super funds, it's saying, listen, when you can't accept new members because your performance has been subpar for the last 2 years. So it really is incentivizing and creating an issue for super funds to really be, I suppose, the best when it comes to their overall performance and investment strategy. Stapling of superannuation accounts. So this is a big one, and I think it's about time that this came through. They've always talked about it, but it's something which just needs to action. I suppose when we start working in Australia, we're given a tax file number. That tax file number follows us for the rest of our lives. But if we change employers multiple times throughout our life, it's always the case where it's quite common that we're going to have more than 1, 2, 3, 4, I suppose, super funds. At the moment, there is currently 6.6 million duplicate super fund accounts. So if you have several super fund accounts, remember, you're paying multiple fees, multiple administration fees, multiple insurance premiums as well. We're then essentially just throwing money away. When we're an expat, a lot of those things might actually not be valid as well, such as the insurance. Check the definitions. And I suppose worst case I've seen was a member had 12 super funds and 2 or 3 of those were duplicates, which I still can't work out how that happens with the same super fund. They've got a duplicate super fund, they use the exact same details, but they've created a new account. From the super fund's point of view, they're just charging their minimum fixed fee again, additional revenue item. But stapling super accounts, great measure being brought in. From 1st of July 2021, there'll be a new measure designed to reduce duplication of accounts involving the stapling of an existing super account to an employee so that the account automatically follows the employee to a new employer, much like our tax file number. Of course, any product that the employee's account is transferred to on cessation of employment must pass the underperformance test as per the previous slide. The government also anticipates improving payroll software to support the stapling of accounts. An Australian Taxation Office tool, ATO tool, will be introduced to help new employees to compare superannuation products. Right now, I think they're just building out and making that MyGov system more robust, especially when you go to the ATO service. It's got your list of super funds. I'm imagining that's the tool that they're going to introduce there. So when you log in, you can have a look and go, okay, well, these are the top 10 super funds based on performance, risk, and fees. So it's really good to see that that's just going to be right in front of us. We can access it quite easily in the future. Early access to super. So at the moment, this was announced a little while ago, but they've already, I suppose, extended the application to add, or I suppose access, an additional 10,000. They did it in the previous financial year, and then they've done another one now. So drawing down an amount between 2020, 2021, applications can still be made up until 31st of December 2020. So those experiencing hardship due to COVID-19, I suppose we've run through the ATO's guidelines on this with a fine-tooth comb and just trying to identify how this applies to non-residents and whether there's any issues, but superannuation is agnostic. If you meet the criteria as defined by the ATO and the government, then accessing your super, I would say, would be okay. However, remember, you're in a foreign jurisdiction, so that jurisdiction might treat that as income, or it might treat it as something else. Those sort of things are shared via common reporting standards, which has 146 countries sign up to. So just be mindful of that, how it might be treated. from a tax position. But again, I suppose if you're in financial hardship, that's probably your last concern. You mainly just needing something to keep you afloat in the meantime. But they have extended that, and applications again can be made up until the 31st of December 2020. SMSF and small APRA funds, self-managed super funds, so that's what SMSF stands for. I'll go into, I suppose, SMSFs in another webinar, but essentially if you're an expat or going to become an expat, you need to be very, very careful with maintaining a self-managed super fund. Just because of one, not being able to meet central management control rules and potentially breaching the active members test as well. When we're running a non-compliant super fund, we can get taxed up to 47% on the assets and the income alone. So if you are running one right now, just tread carefully or seek advice to make sure you've got it set up appropriately. But again, rubber stamping can apply there, but I'll go into that on another webinar. I'm not going to delve into that today. I suppose this is overall a positive. So in the 2018-2019 federal budget, the government proposed to increase the maximum number of allowable members in self-managed super funds and small APRA funds from 4 to 6 members commencing from 1 July 2019. This measure is now proposed to commence from the date of enabling legislation receives raw assent. So by being able to have additional or 2 additional members, it just means that we can have more funds in an SMSF pulled together for investing, buying property, investing in infrastructure, commercial assets, those sort of things. So being able to add an extra 2 members, can really bolster an SMSF as a whole. It's really great for families as well when we're talking about intergenerational, I suppose, wealth shifts with inheritance and estate planning. Moving through onto the next item, being equity markets. So this is mainly just an update, how equity markets have been tracking. We gave a great update in our previous webinar about equity markets and our thoughts. So let's jump into it together. So I suppose on the screen right now, we can just see the ASX 200 since the start of the year. So we can see, pre-COVID-19, the big drop and then the market relief rally. But as we can see, since about June, mid-June, I suppose the market's just been tracking sideways. I suppose in the short term, there's still some weakness that could be felt or some downside risk, or I suppose it means there's buying opportunities that are still in play right now. I suppose with the amount of cash flowing through businesses just from the stimulus packages and the initiatives being created there, we would say that in the meantime it'll probably stay on its current course a little while longer, so still tracking along, but there is still, again, buying opportunities there depending on the sectors that you're looking at. I suppose when we reflect on the budget, the government was still talking about vaccine until the end of next year, so, and also opening our borders at the end of next year as well. So a very long time. So again, we could see some more, or this mentality of a risk-off approach where people sell out of the market, and there's, there is room for weakness there and a subtle pullback. But right now, in the meantime, we'll just see it probably continue tracking along, especially now that the budget's been announced. There's always concerns or uncertainty leading up to a budget, but we've also got, I suppose, the current month right now. We look at the US, October is going to be a decisive month. And the reason why is, well, we've got Trump recently announced that he's going to push pause on just announcing any more stimulus measures or stimulus packages for the US. So millions of Americans are going to struggle there, which is a concern. I suppose we've got the impact of Trump versus Biden. I suppose if anyone watched the recent presidential debate, you would have noted that it was almost like watching a reality TV show on Netflix or something like that. It's a bit ridiculous that these are the two that are next in line at the helm. I suppose the US dollar, it's always going to be volatile as well around this period, just due to everything going on with Trump and Biden. I suppose a lot of people will be fleeing and probably piling into US dollars as a safe haven, while there's just that short-term volatility as well. But again, this short-term volatility, while there is weakness and there is room for weakness, it always does present buying opportunities, and that's what we've been seeing: people, retail investors, jumping into the market when there's a bit of a pullback. And then it does this exact pattern where it's just continuing that sort of measured whipsawing effect and just tracking along the same sort of line at the moment, not breaking support but not dropping either. This isn't something which we would treat as a thesis for predicting the election results, but it's an interesting, I suppose, fact that we've come across. Markets have tended to predict the election results. So a simple stock market metric has currently predicted the winner in 20 of the last 23 US presidential elections since 1936. Pretty good sample size. A track record that might make even some of the top pollsters jealous. If the S&P 500 index is up in the 3 months prior to election day, the incumbent party, being Trump, usually wins. If markets are down during the period, the opposing party typically claims victory, being Biden. Again, we're not treating this as a market thesis, but it's just an interesting fact. So I suppose, what does this mean for 2020? Well, as of September 15, the S&P 500 was up 3% since August 3rd, so 3 months prior to the election date, and 5% up year to date, the US market again, S&P 500. I suppose in normal times that would favour the incumbent, being Trump, but today's shaky economy offers a different story. Since 1912, only once has a president been re-elected if he oversaw a recession within 2 years of the election. So I guess you could say that due to COVID-19, this sort of thesis can't really be used just because it sort of throws everything out of play. So again, the S&P 500's average returns during election years, 1936 to 2016, so incumbent party won, would have a good lift. If the incumbent party lost, pretty stagnant year on year. So again, just an idea of what we've seen in the past, not really a predictor or a thesis for right now, given COVID, but just an interesting fact. Turning back to the local markets, Australian markets, bit of a three-horse race at the moment. So as we can see here, the financials not been profitable for some time. I suppose a lot of retail investors are drawn to them and have been drawn to them for a very long time also because of their dividends, their consistent franked dividends. But from a profitability point of view, on an index or investing in 100, they have steadily declines there. And I just can't see them being profitable for some time. I think financials were probably quite lucky with the recent announcement of relaxing the lending rules. So it'd be interesting to see what comes about from that over the next 6 to 12 months. We can see here that resources fighting back since 2015, end of 2015 I should say there, and then we can also see that all other sectors, your healthcare, your consumer staples have been doing really, really well. Even through COVID-19 they've rallied quite strongly there. I suppose when we look at, if we're investing in, say, an ASX 200 ETF, so just one ETF which spreads us across the ASX 200, a main concern with that sort of methodology, if you're investing, is that 38.5% is exposed to banks, the financials, because that's their market weight and that's how those indexes are run. So it just means that if you're investing in those kind of straightforward ETFs, there's a bit of concern that yes, you're overweight in something which hasn't been profitable for a very long time. And I suppose with our own sort of viewpoint on an approach to an investment strategy, we will use ETFs or index funds to get exposure to the international sectors, and then we will pick our own, I suppose, blue chips within the sectors. And being underweight of financials is sensible, but again, it depends on your own goals, how often you're trading, and your sort of time horizon on what you're picking there as well. I suppose one thing which has also helped Australia when you look at sort of our market alone, we're not heavily reliant on things like the holiday or I suppose the hotel industry compared to other countries where they are mainly just bolstered by their tourism industry alone. Fertile ground for sector picking. So again, this graph, it's a great example of themes that have done well off the back of COVID-19 and have rallied well. I mean, no surprise there that we see IT. I mean, most businesses that can, service-based businesses that can have gone online. They're using, I suppose, your Zooms, your GoToWebinars, your Microsoft Teams. They're working from home, so it's no surprise that the IT has done really, really well. Next in line there, we see healthcare. Again, not really see a prize there. I mean, you look at companies like Ansell, they've rallied really, really well through COVID-19 just because of their raw demand of their raw products or their products alone. Consumer staples, your Coles, your Woolworths, your Wesfarmers to a degree, people spending a lot online. So again, we can see that's done well. throughout COVID-19 up until now. I suppose the biggest item for us is that there's just still a bit too much uncertainty in the market. I mean, we look at, I suppose, energy right now. I suppose if we relate that to the raw demand for energy products, your oils, your fuels, those sort of items, when we look at I suppose one of the big ones, tourism, travel, aviation, there's just no demand at the moment. I mean, you look at Qantas, they've grounded their international fleet until March next year, then they're reassessing. So we probably predict that the energy sector is still going to feel that pinch in the short term, obviously until the readily available vaccines and borders are reopening, or at least until there are some sort of bubbles starting to develop where you can travel across, and there is a small demand there for international travel, for holiday goers and those sort of things. Real estate, not really a huge surprise there, especially if you look at the commercial side. A lot of big businesses, they've pretty much gotten out of their leases. They've moved, 60 or 50 to 6% of their workforce are working from home, online. No issues with running that kind of concept with a lot of businesses, especially down in Melbourne and Sydney. So we expect that real estate will continue to feel that pinch in the short term. It's best focusing on sort of thematics within that real estate sector, rather than probably taking the broad approach now, making those sort of changes towards things like maybe, if you're thinking out loud, Bunnings Warehouse, what they're renting through in terms of their sort of trust systems. But again, always seek advice, but focusing on thematics within the property industry is going to be a better approach now. Moving into the property market, so touching base on our thoughts on the property market at the moment. If you tuned in last month when we held our sort of market analysis updates about earnings season, we already painted a pretty grim picture of property market. Two of the big four bank CEOs predicting that on average Australian property market pulling back up to, I think NAB said up to 27% worst case scenario, whereas the CBA executive CEO, he was saying that, listen, if you've got equity in your property now, and you're struggling to make ends meet with your mortgage repayments, you should consider selling, because that equity might not exist in 12 to 18 months. So all he's sort of saying there is that if the property market does pull back, the value of a property is pulling back, but your loan to value ratio is just increasing to a point where you might not get your money out. So at the moment, I would say that we haven't really seen the full effects of the property market really stumbling. I suppose what's concerning us right now, the extension of rental eviction moratorium, so that's still going on. I suppose 1 in 5 customers who have deferred loans are ghosting banks. So the concept of ghosting, just essentially not replying, not responding to the bank requests at all, not answering their calls. So that's a big concern. A lot of that will be also on personal loans, as well as that last one being negative migration. So I suppose with the extension of rental eviction moratorium, it's starting to hurt a lot of landlords. Tenants, especially down south, Victoria, New South Wales, that aren't paying their rent, just staying in the property. They can't kick them out because of obviously these rental eviction moratoriums. So what that means is, might see owners trying to sell because based on no rental yield coming through, they can't actually afford or pay down their mortgage repayments. So you might see more properties or more investment properties going on sale compared to your owner occupied taking place. Negative migration, that's a big one because in the past, obviously a lot of foreign investors and migrants coming across have usually taken up the slack from an investment point of view or property purchase point of view. But in terms of market participants in the property sector, there's 4 mains. So first home buyers, owner occupiers, investors and migrants. I suppose recently I was talking to a gentleman who's a real estate agent here, and he said, there's plenty of first home buyers, especially on the Gold Coast and Queensland, that are trying to purchase right now, but they are, making offers, but then when they go to the banks, they're just getting turned away from a serviceability point of view. So he said that whilst first home buyers, there's plenty of them right now, there's not much that's actually getting put through. Owner occupiers is probably what's making up the main turnover of current stock, sort of cashing in, selling property and then buying something a bit bigger because, cost of living or the cost of owning that property is a bit less now that the interest rates are staying quite low. I suppose if you attended our last webinar, we put out some good facts there. I think we looked at default rates overall of all loans, mortgages were at 11%. And 11%, so that 11% which were at default, the LVRs on those properties was more than 95%. So where that's going to head in the next 12 months, that LVR is going to go well above that 100%, which means you're in negative equity. The loan is worth more than the property. So it'll be interesting to see what takes place and, see more selling. The last one being migrants. I suppose at the moment, just because migration, not really taking place at the moment, we're going to be heading into negative figures with migration or net migration. And that's what this next slide talks about. Again, the property market, it's usually taken or relied on foreign investment or migration to take up that excess slack, but at the moment we're seeing that negative migration is going to take place initially just due to COVID-19, but net overseas migration is significantly affected by international travel restrictions and weaker labour markets domestically and globally. It is assumed to fall from around 154,000 persons 2020 to be around negative 72,000 persons by the end of 2021 before gradually increasing to around 201,000 in 2024. This next slide just gives you that example data from the budget itself. So Australia's population growth is expected to fall to 0.2% in 2021 and then 0.4% in 2022, the slowest growth in over a century due to the net overseas migration, which is expected to be negative over this period for the first time since 1946. So we can see here in 2019, the NOM figure was 239,700. So this is based on people leaving and people coming back in. 2020, 154,000. Now 2021, negative 71,600. 2022, negative 21,600. And then obviously expecting that it'll begin to pick up because that'll be in a post-COVID world with vaccine and travel restrictions obviously released. It's most likely that I suppose the major cities such as your Melbournes, your Sydneys, they'll feel the pinch with this just because that's where most migrants will gravitate to for work and those sort of considerations, and then initially moving out to maybe Queensland or Tasmania or South Australia and WA. So last of all, currency markets. So where is the Australian dollar at? So I suppose in past webinars, we've certainly gone into a lot of detail of what a sort of risk-on, risk-off approach is with the Australian dollar. Essentially, when investors are nervous, they don't know what to do and they run to something which is a bit more secure or considered a safe haven, which is the US dollars. So I suppose in September, after breaking 74 US cents, the Australian dollar fell against most of the major currencies. The potential second wave of COVID-19 is dampening expectations for global growth, and the US election uncertainty is driving a risk-off sentiment, which does not benefit the AUD. Should the RBA cut rates and the market appetite for risk continue to sour, so still taking a risk-off approach and flocking out of the Australian dollar into the US dollar, the Australian dollar could be trading between 68 cents and 70 US cents in the short term. I suppose what we're seeing right now, I suppose especially June, July, when we saw, I suppose, the green bars ticking up, which came across as the pandemic was being managed. But we've got to remember that right now there's 18% more US dollars in the global economy that's been printed by the Fed. So initially it took a little while for those dollars to be taken up, and we saw obviously the Australian dollar rally and do really, really well and sort of gain, but it wasn't a case where the Australian dollar had appreciated. It was actually a case that the US dollar had depreciated due to oversupply, and we're seeing that that's being taken up right now. So interest rates are key. So at the moment, the Reserve Bank of Australia's hint on Tuesday that it may ease monetary policy next month has caused selling in the Australian dollar, so a risk-off approach. So the Australian dollar is no longer offering some sort of, I suppose, benefit when you, I suppose, risk for reward. Therefore, people moving over to the US dollar as a safe haven. Policymakers elected to leave interest rates at 0.25% on the same day as the budget, allowing the Australian dollar to jump through 0.72 to touch 0.721. Before suitably dovish statement paved the way for a 15 basis point cut and additional quantitative easing measures coming through November. This will certainly weigh on the Australian dollar as more international investors take a risk-off approach, as there isn't a reward for investing or holding Australian dollars, as is expected to take a bit of a pullback. I suppose anyone that's in a jurisdiction where your currency is tied to the US dollar, that might present an opportunity in November to transition US dollars or your currency into Australian dollars, because it's an easy way for you to make a currency gain, something you can control based on what the markets are doing. So that's just a little gimme in terms of if you are thinking of sending money back to Australia in the short term, you might see that the Australian dollar might weaken, so presenting an opportunity to make an easy currency gain compared to where it's been in the last few months, where it's been above 70 cents. So too are the US elections. So having consolidated at this handle, the Australian dollar came under added pressure as risk sentiment flatlined following the confirmation that President Trump and the Republicans have withdrawn from coronavirus relief talks. So obviously, pushing pause on further stimulus. I suppose another item which was interesting to see was when Trump announced that he had COVID-19, that made the news. The US futures market was predicting a drop up to 3% at the open, but that didn't happen either. So it's very interesting to see how quickly and how emotional the markets are in the US. The expectation of the government-led support has been a key driver behind positive sentiment in recent months, and the abrupt about-face has dashed any hope a relief plan will be available ahead of the election, extending the timeline of hardships for millions of Americans and sapping the market of a risk on demand. So that's just, again, a reflection that they've pushed pause on any more stimulus talks until after the election, and then we'll know more then if there's a new president and what approach they might take. I suppose the longer this goes on, the more uncertainty that builds. A vaccine announced, say, tomorrow or next month would certainly put it all to end and flip it on its head. I suppose we all are watching that Oxford vaccine with that the AstraZeneca vaccine closely. Playing the US dollar safety card, so treating the US dollar again as a safe haven, which we saw in the big drop through March and April, where there was just, I suppose, almost was undersupply based on when you looked at the Australian dollar getting down. I think it was 58 cents briefly, but the graph certainly reflects the market playing into the US dollar safety card. I mean, as we can see there, back in March, you were frozen by fear, analysis paralysis. Didn't know what to do. Many were just flocking to the US dollar just because it is that safe haven, that major trade currency. I suppose it's tracked well since June, and then the Fed released, I suppose, and has been feeding out that 18% more, which I announced earlier, which, as you can see there, it's tracked backwards. But again, we've seen how emotional it can be. Obviously, President Trump announcing that he's okay after COVID-19, the market certainly reacted quite well to that kind of news. I'm going to wrap it up there. That's all we're going to discuss today on the budget and just those minor market points. I'm just going to now open it up to some Q&As. Some questions have been coming through, so I do appreciate that. This doesn't necessarily need to be budget specific. It can be just expat specific in general, non-resident tax, those sort of things, something you're not aware of, something you need to know. I'm happy to address them. I'm just going to take a quick sip of water, and then I'll start addressing them as they've come through. Rightio, guys, I can see here questions come through. You mentioned managed funds held by trust qualifying for a 15% withholding tax as opposed to the 30% tax rate, and also the 50% capital gain reduction regardless of where the beneficiaries live. Can you go over that a little more? So just to go over that again, if we are in a country which does not have a double taxation agreement, then it means that the platform in which we're investing through, or the managed fund, one, they need to know that we're a non-resident in the jurisdiction in which we live in. Two, if there is no DTA, they are required by law to withhold 30% withholding tax on those income distributions, especially if there is no franking credits attached to that income distribution. With the change that's taking place right now, with increasing the tax treaties as well as the information exchange agreements, they've now included those other jurisdictions. One of the major ones where I know quite a large amount of expats reside is Hong Kong. So they've included that now, which means that rather than a 30% withholding tax amount applying to income or unfranked income, it now means that a 15% withholding tax amount will be applied. So you're saving yourself 15% tax, which regardless of what the DTA states, if you're applying, say, 30% and you're in a jurisdiction where there is no DTA, even if the withholding tax or the tax on that income in your jurisdiction is only maybe 10% or 15%, you don't get a tax credit refund or anything like that. It's one thing that non-residents need to be mindful of. If you're receiving a tax credit or a franking credit refund each year from dividends, then I would say that you need to have a conversation with your accountant, because non-residents do not get franking credits refunded to them, regardless of what the withholding tax rate should be. So if you are, there's either a case where maybe you're not treated as a non-resident, it hasn't been lodged correctly if you're self-lodging, or two, you need to go back and have a chat to your accountant about what's being lodged there. Another question here, just moving through it. Aside from property mortgages, have you found costs effective leveraging for investments? Most margin loans are expensive, over 6%. So I think that's referring to just buying maybe direct equities or equities on margin. Correct me if I'm wrong there, William. But if we're buying on margin as a non-resident, remember, we don't get the benefit of the interest expense being a tax deduction. With the volatility in the markets right now, even though we're in a low interest, low inflation environment, and most people would prefer probably equities over bonds because of the return difference, depending on the time frame that we're holding them for, I still, to any clients, I wouldn't be recommending buying on margin just because of the volatility in the market. But yeah, most margin loans, they're going to attract a rate anywhere between 6 to 10% with the volatility in the market. You might unfortunately get an equity or a call, margin call, which you don't want. I don't think we're going to see a scenario where we'll see the market drop like it did back in March. I think it'd be a case where we'd have to see a new pandemic essentially. But right now, most countries, they've got the infrastructure, they've got the roadmap on how to handle it. So we're not going to see that kind of drop again, but we might just, as I said before, keep tracking the way we're tracking right now. In the short term, there's room for weakness, which presents buying opportunities, which we've seen. One thing which will be interesting to see towards the end of the year, as well as January, February, is this cyclical effect that we all see in December and January. It's actually called the January effect, needs a better name, but essentially it means that a lot of major fund managers, they are cleansing their portfolios, doing portfolio rebalancing. So there's a lot of buyers and sells which are going on, and off the back of that, we always note that there's always a cyclical effect where markets usually rally between January and February really, really well. So it'd be interesting to see if that takes place this time round, just due to the one, US presidential election about to take place, two, we're in a COVID world, and I suppose three, low inflation, low interest rate environment as well. Another question here, just general about interest rates. When do you think interest rates will rise in the future? It's a very good question, but I don't think the RBA will be able to play too much with interest rates, probably for at least 2 to 3 years. I think, if anything, we're going to see probably another cut next month, and then I think they'll stay pretty much on par like that for at least 12 months before they maybe increase by 0.25%. Remember, we're almost on par or neutral rates or no cash rate essentially, so any kind of impact on loans and those sort of things won't be drastic. But I just can't see interest rates increasing quickly for at least 3 years, to be honest. And that's probably why, when we look at the property market, a lot of the stock that's being turned over is owner-occupier. They're selling what they have now, they're moving into something maybe a little bit better because, one, the employment's still secure, but they can afford the ongoing holding costs of something a bit bigger. Just because we're in that record low interest rate environment. A bit different for investors where rental yields have fallen, and they'll probably continue to fall for the next 6 to 12 months as well. So owner-occupier, that's where we're seeing mainly, or the main property stock turnover at the moment. A question here from Andrew. Can a person still opt into the new employers fund even with the new stapling feature? They certainly can. With this change of this stapling feature, it's annoyed a lot of unions, to be honest, because a lot of unions, you know, they sort of manage and negotiate these EVA agreements saying we can only use this super fund and we can only pay contributions into this super fund. A lot of those are gone now, except for some of the government ones. But you'll still be able to use one of your old super funds or the new super fund with the employer. There's sometimes benefits for using the employer's super fund because you might have a benefit where they're paying insurance premiums on your behalf. I know a lot of the big four accounting firms, they offer some of those incentives. A lot of the banks, they do that as well, where your insurance will be free if you're signing up with those products. But again, that's something that will probably be reviewed as part of that tool, as part of that HO tool that they're going to bring into effect as well. But you certainly can still use your new employer's super fund. You don't have to use your old one. I mean, you can create your own super fund if you wish. I've just got another comment. Andrew, can you hear me still? You're saying that you've lost audio, but I haven't heard anything else from other people. Yeah, all good. Okay, no worries, mate. Okay, another question here. CGT main residence exemption for expats. It was abolished this year in July. Good news in the new CGT exemption for granny flats coming into context next July. Is there any news on expats purchasing in Australia when living in the UK and being able to benefit from these? I suppose when we look at the expats, when we look at the main residence exemption and granny flats, we need to, one, it still needs to be our main residence. We need to essentially be residing there if we're going to get this granny flat exemption. And then taking that granny flat exemption a step further is there actually needs to be a formal agreement to prove that it is for an elderly person. And you know, that way when we sell the property later in life, there is no capital gains tax applied to that portion of the granny flat. So it is a really good benefit. It's going to provide some good benefits from a yield point of view, especially for maybe first home owner buyers that, you know, maybe they want to achieve maybe an additional $200 to $300 per week by building a granny flat onto a first home or a newly purchased build. But again, there needs to be a formal agreement in place. You know, for an expat, we need to actually be living back in that property as well because it needs to be our main residence, and we need to have that formal agreement in place, which is usually need to be provided to the HO or government. Another one here, if I'm living in the UK and withdraw super into an Australian bank account, will I get taxed before I'm overseas? I've reached preservation age but not retirement age. Yeah, a good question. Firstly, let's start on the Australian side, you know, if you're a non-resident. So superannuation, it's agnostic, regardless of being a resident versus being a non-resident. So if we have met our preservation age and we are technically, you talk about preservation age and retirement age. Preservation age, you know, generally now is 60. If we reach our preservation age and we are retired, we can access the super. We can access that super based on the Australian legislation. However, depending on where we reside, we might have to pay tax. In your case, the HMRC might tax you on that as an income source. When you're residing in the UK, there's two different sort of tax lodgement systems depending on the way you're working, whether you're on the remittance system or the other systems. So first off, before you look at doing that, if you're going to be drawing an income stream from an Australian super fund or pulling out a lump sum, speak to an accountant just to see how they would treat it. Sometimes there's ways that you can get around having to pay tax on the withdrawal as long as that you don't remit it into the UK. It stays in Australia and then you bring it back in the next financial year because it's treated as savings. Again, don't treat that as advice. Speak to a UK accountant on how they would tax that, maybe that once-off lump sum withdrawal. But again, back here in Australia, if we have met our preservation age and we are retired at that point in time, so in this case that might be in between 60 and 65, we can technically access it. It's a declaration which is made to the super fund for that confirmation. There's no additional tax to pay here in Australia usually, and again, depending on where you're residing, the treatment of that might be treated as foreign sourced income, so you might have to pay tax to the local taxation authority. Another item here, has there been clarification from the ATO on reports that they are no longer treating gratuity schemes like the Singapore CPF or Hong Kong MPF as a foreign pension fund? There hasn't really been further sort of clarification on that. I think one of the major items or issues that we're seeing right now is if expats are being forced back to Australia early just due to COVID-19, their role might no longer exist. They're sort of given garden leave and they might have a gratuity or a benefit paid out. Best to seek Australian tax advice pretty quickly just to see how the ATO want to tax that, whether it's going to be treated as foreign sourced income, whether it's only going to be taxed on some sort of component of it, depending on the years in which we're, or days in which we're back in Australia. A lot of the foreign pension systems or foreign pension funds commonly treated and taxed by the ATO as a Section 99B foreign investment trust, which means that the ATO won't tax us on the contributions we've made or our employers made, maybe through a salary sacrificing scheme, but the investment growth, the capital appreciation, the income within that fund, that foreign pension fund, is treated as assessable. So that might mean that we might need to look at ways which you can reduce that assessable amount. That might operate with an Australian super fund. There's plenty of different options there, but again, that's one of the major issues we're seeing. People are being forced home. They either leave the provident fund there until maybe they return in a post-COVID world, so they don't get taxed on it, especially if it's quite large, or they withdraw an amount out of it and are taxed by the ATO under the Section 99B foreign investment trust rules. So that's an interesting one. I suppose a few other questions coming through. This one's a bit long. Joe, I'll try and read this out and address it as best as I can. I sold my house in the US in March. They withheld about $40K in tax. When can I get that money back? I'll have two small statements, 2020 for interest, yep, which I can state values already. So it's probably likely that you got, if it was a former main residence and no tax should have been paid on that because you're still benefiting from the main residence exemption. There's a lot to be sort of left out of that comment you made. But if it was still covered under the main residence exemption and should have been a tax-free transaction, you're probably caught by what's called the foreign resident capital gains withholding tax regime, where if we sell a property that's worth more than $750,000, the ATO will automatically apply that I think it's 12.5% is applied to the overall proceeds, which means that amount or applied to the capital gain sent to the ATO straight away on settlement. And then it means that you're incentivized to actually lodge a tax return to prove that that was your main residence, you were qualified under the main residence exemption, and that means you'll get a tax refund. So right now, because you've paid that tax when you sold it here in Australia, you should look at I suppose, going to the ATO and applying for a tax credit refund depending on the circumstances there. With regards to another question here, I'm just going through it. Thanks, Jack. I'll just read out your question. Are currency gains made from foreign currency AUD movements taxable? It's a good question, Jack. Now, because I'm going to take the assumption in this question that you're a non-resident and you're sending money back to Australia either from a US dollar or foreign currency source, and you're making an easy technically currency gain just based on the movements over the last, say, 6-12 months. So as an example, if you had US dollars and you sent money back at that 58 cents mark back when early March, and you make a great little foreign currency gain, technically, no, it's not a taxable item here in Australia at all, because remember, you're a non-resident. So sending back currency or after-tax dollars, it's treated as a non-taxable Australian property item. You'll likely be putting it into an Australian bank account, paying down debt, putting it in an offset account, putting it into, say, direct shares. As we always say to our own clients, when you're sending money back, you don't want to leave that money in a bank account or an interest-bearing account for long. You want to give it an active purpose. Just because, someone that's sending back, say, thousands of dollars each year and just is accumulating this somewhat big honeypot, not doing anything with it, I think that could be frowned upon depending on your movements and what your sort of circumstances are and habits are. But no, if you're a non-resident, sending back money to Australian dollars, making that conversion, no currency or taxable currency gain, because again, you're a non-resident. It's treated as a non-TARP asset. A bit of a long question there, Andrew. I think I'll address that one individually. Actually, I might try and address it now. You've made some comments here about super funds, which I think a lot of people will get some good value out of. So in the current and near future environment, would it be better to make after-tax contributions to our Australian super funds or to our Australian mortgages with our expat dollars? That's question one. Are we allowed to make after-tax voluntary super contributions from overseas income, considering no Australian tax has been paid on the income? Both good questions, Sandra. I'll address the second one first. So at the moment, again, superannuation is agnostic, regardless of us being a resident or a non-resident. So yes, technically you can pay an after-tax contribution into your super fund, and it can be treated as what's called a non-concessional contribution. It's not frowned upon by the ATO or anything like that. I will make I suppose a caveat that if you are in the US, you need to be very careful paying money into super unless it's covered under what's called a certificate of coverage through your US employer. If they've got an Australian employer, then you're still getting the benefit of superannuation contributions. If you're paying after-tax dollars into an Australian super fund and you're a US tax resident, you've got to be careful when you do that because, one, it's something that technically should be declared to the IRS on one of their information returns. And when we do that for long enough, it means that we essentially treat or change the beneficial interests of that super fund coming from 50% of our own contributions, after-tax contributions. When that takes place, it's highly likely that, it'll be treated as what's called a foreign grant or trust, where taxation will arise on the investment earnings, the growth, and we need to actually complete a lot of other information returns, and it creates a bit of a tax nightmare. So just be mindful of that. If we are in the US, again, I know that's not applying to the Asia Pacific region, but if we're contributing to super, a bit of an issue there because just the way the IRS does tax those certain items. First part of your question, I believe, was, would it be better to make after-tax contributions to super funds or to Australian mortgages with our expat dollars? Again, really good question. Right now, you've got another option there, which you haven't really talked about, yes, you can put money down on mortgages or in an offset account. It's reducing your interest expense, reducing the interest tax deduction. But remember, when you do that, you pay down the mortgage. It also means, on the other side, technically you'll be increasing your net income on the property. You're probably thinking, James, what's wrong with that? I'm increasing my net income. Well, the issue is that, remember, you're a non-resident. Your non-resident tax rates on that kind of income from TARP assets is taxed at 32.5%. So it means that while we are paying down debt, which is a good thing, we're also increasing the net income, but then we pay almost 1/3 of that income to the ATO in tax. So what you could look at doing is, technically, yes, pay down a bit of debt, maybe get the property to neutral positions, and then look at else or other ways in which we can use that free cash flow. If we're not in the US, super is okay. After-tax contributions is okay. If you have a self-managed super fund, be very careful. Seek advice before you do that. Normal retail super funds, like your REFs, your Australian Supers, your HESAs, that's okay. There's no issues there. Or the alternative is, okay, you might get a scenario where you bring your property up to neutral income position from a tax position, and then you can invest the remaining spare cash flow or surplus cash flow into sort of your direct equities. Remember, they're treated as non-TARP assets. No capital gains tax will, accrue on that asset or that portfolio from an ATO's point of view, because again, you're not here in Australia, you're a non-resident. So that's a tax-free asset growing. That's an alternative. So those are some options that you can consider, Andrew. I don't want to go too much into it just because I don't want to trip over that line of specific personal advice. But again, today has just been purely for entertainment purposes. The next, there's a few more questions coming through, and I will address them. Just going to move over to the next slide. Just because we are in that Q&A section. And if you do have any specific questions or need to reach out at all, please jump on our website, www.atlaswealth.com, submit an online inquiry. Depending on where you are, which I think based on probably the time right now, you would probably be in the Asia Pacific, America's regions. If you're in the Middle East or Europe region, it's quite late at night, and I'd be impressed. But essentially, you can submit an online inquiry. It's going to come through myself or Brett or one of the other advisors, and then we'll touch base on it through there. If you are on the socials, please do follow us. We do, whenever we do an update or a comment or a blog article, we send it through on those socials as well. But getting back to some of these questions, I suppose, Cheryl, you put one in there. I'll do my best to address this one. I think it's similar to the one before. My family recently sold a property in Australia, which was left to me and my siblings in his will. Yep, I live in US. I must share the proceeds taxable in either country. So I'm just going to redo that one. Family recently sold a property in Australia which was left to me and my siblings in. There's a few points there, Cheryl, which I probably need a bit more information on. How long you held the property for before it was sold, when you first inherited the property, because you're in the US, whether you're a dual national or not, usually it's an item which, from a US point of view, we need to submit an information return saying that we received this asset, not taxable, but we've received the asset. From the Australian side, if it was a former main residence and it was sold within 2 years, even regardless of those main residence exemptions being abolished, then that's our sort of grieving period where we have 2 years to sell it, and it's usually a tax-free item. What you do with those assets after, that could be taxable depending on where you actually put the assets. But again, there's a little bit more that I'll need to know just to sort of flesh out what you're trying to ask there. I suppose just having a look at some of these other questions, they are a little bit personal, so I just don't want to go into them too much. I'll try and email back to you just so I can address those, just going through them. Another item that was said here, looking at this, going through. Currency platforms. Are currency platforms something which is shared on common reporting standards? That's a very good question, and I would say yes, but remember, currency platforms, it's not a holding account. It's usually using a currency platform such as OFX, TransferWise, World First. Usually what we'll do is we'll create an account on there. We will need to probably provide our TIN, tax identification number, and to open an account. And what we're doing when we're sending money between countries is that we're logging into OFX as an example. We're creating a money order saying I want to convert 5,000 US dollars to Australian dollars. This is the receiving Australian bank account, pushing it in, it does the conversion and then pushes it off into our receiving bank account in Australia. It is something where it would be shared, but at most of the time you're not going to be holding funds in there. I will say, however, though, I know TransferWise has this concept of a borderless account. Those borderless accounts are registered somewhere technically, so whatever you're holding in there, whether it's multiple currencies, it is something that would be shared. So if you're sort of trying to think of ways to hide money, there's not a great way really to hide money, not in this shrinking digital world. Funnily enough, one of the only countries which isn't signed up to, I think, common reporting standards is actually the US, which is somewhat ironic. In a case of do as I say, not as I do. So sometimes people make the joke that it's better to hide your money in the US rather than anywhere else, which is a bit ridiculous. I suppose final thoughts, going to be releasing the recording over the next few days. Just probably going to do some tweaks and amendments. We'll send that out via the email list, but that wraps up today's webinar. Hang on, there's a few more questions that just want to get answered. That's mainly, sorry Chad, that's mainly a sort of a France tax item. I wouldn't be able to address that one, but I'll come back to you, Chad, on an email. One more question, which might be a bit specific, just for expats in general. Annie's just shot it through. If moving back to Australia from the US or moving back from another country and having been away for 10 years, how long would we have to live in the property again to avoid paying capital gains tax in Australia? I reckon, so again, you've been away for 10 years, you've rented out that property for probably 10 years. Remember that the old main residence exemption, it only covered us for 6 years in terms of the temporary absence rules. So what that means is we'd buy a main residence, we'd move into it, we'd live in it for a period, expat, move overseas, rent it out. We can rent it out for up to 6 years. After 6 years, the old rule states that, if we sell it after 6 years of renting out, yes, we're going to pay some sort of CGT, but we used to get the benefit of a partial main residence exemption whereby the market value of the property from the first day in which it was rented was treated as the updated or amended cost base for capital gains tax purposes. So that was beneficial because it meant ideally less CGT to pay when we lodged that transaction. If you've rented out the property for more than 6 years and like you said, you're returning after 10 years, there is always going to be a 4-year period there which is taxable. No way of getting out of that, regardless of how long you reside in that property, always going to be 4 years which is taxable. Do not sell until you are back in Australia, an ordinary Australian tax resident. Again, to be satisfying the test to be a normal Australian tax resident, again, look at your tax residency tests. The primary test being the resides test, where you're residing permanently. Well, someone that's returned and residing permanently in Australia, they're back, they have obviously, electricity in their name, the kids are in school, they're working here as well, they've got, accounts in their name, those sort of considerations. They've cut ties with their old foreign jurisdiction. And, when you look at the other secondary tests, the 183-day rule in the same financial year, you probably wouldn't want to sell that property for at least 6 to 12 months minimum, just to make sure the ATO doesn't use their Part 4A anti-avoidance rule, where they sort of audit you because they think you're trying to skew the system. So 6 to 12 months minimum probably being back in that property before you sell it. And then outside of that, again, if you've rented out the property for more than 6 years, there's always going to be that 4-year period, which is taxable. No way to get out of that. That's just the rules. That applies to all of us, whether a resident or a non-resident. All right, guys, I might wind up there. As I said, the recording will be going out over the next few days, make a few tweaks. If you want to jump on the socials, feel free to follow our pages, Facebook, LinkedIn. Feel free to add myself or Brett. We try and do our best to post as regularly as possible. And in the meantime, I guess, as Brett always says, we'll see you on the airwaves, see you on the emails, and speak to you soon. Thanks, guys. Speak soon.